Hey, so you've probably listened to your parents or grandparents talk about buying individual securities, specifically ones that pay dividends. And they'll talk about a stock and how much it pays in dividends, and the dividends are so great. And they build a whole portfolio centered around dividends. I think that style of investing doesn't, well, I know it doesn't work long term, but it's come back in the news recently about dividend-paying stocks. Interest rates are rising now, so people are more focused on yield now, as they should be. But ultimately, I asked Brad here, our investment manager, to run some numbers for me. So here, before I talk about any of the numbers, let's just say if you focus only on dividend-paying stocks, there's only really certain industries that have high dividends. And so what happens if you end up with a diversified or a non-diversified portfolio, and that maybe you just have utilities, or you have telecom, or you have maybe financials, heavy portfolio, and you're missing out on so much other side of the portfolio that's really more growth oriented. So that really comes down to two tails, right? So if you focused on dividend stocks only, Brad replicated this using SDY. It's ETF focused on dividend payers, much like you'd build a diversified dividend-focused portfolio. And then we compared it to SPTM, which is a total U.S. market portfolio. So it has dividend payers in it, but it also has growth stocks, it has value, it has companies that are probably categorized as both, called blend, but it represents the entire U.S. market. So if we invested $1 million in dividend-paying stocks only in both portfolios, and we generated $28,200 a year in dividends from SDY. Now we're going to withdraw the exact same amount out of our total U.S. portfolio that has value, dividend payers, and growth stocks in it. And we're going to pull out the equal amount, $28,200. Then we're going to just jump forward for 10 years. Based on how things historically have performed, and based on current dividend rates, the total distributions from SDY over 10 years is about $419,000. In comparison, the total market value and growth stocks had a payout of about $504,000. Now, the dividend portfolio, which you put $1 million in, and 10 years later was worth about $2.1 million. Total economic benefit is about 2.5. So you invested $1 million, you got $419,000 in distributions, and you had a ending value of $2.1 million price, which is a $2.5 million total value to you over that 10-year period. Now, the entire market, you put in $1 million, you pulled out the equal amount, $28,200. Now, you didn't have the dividends necessary to support that, so you pulled out some principal along the way. Well, your total distributions would have evened out at $504,000, plus the price appreciation got to $2.4 million. So basically, that's $2.9 million in total economic value over 2 years versus $2.5 million on a dividend strategy. So this tells us that we need better diversification in a portfolio, but we don't need to focus just on dividends. We have to focus on owning the entire market over that time period, and that additional value is what you're pulling out on a monthly basis in addition to dividends as well. That's stock versus stock. That doesn't really even account for bonds at all inside a portfolio. Obviously, if you add bonds, your income would drop. The economic benefit of the portfolio is going to drop, but so does your volatility. And so that's a whole different discussion on how much bonds do you add to a portfolio to help smooth out the stock market's ups and downs at times, especially in this volatile market. But ultimately, you want to focus on value and growth, not just value stocks. Thanks for watching.